In this video, we're going to talk about 6 types of inflation. In my opinion, it is critical to understand inflation so we can make informed decisions going forward. We're currently in the midst of the worst inflation for 40 years. If you are concerned about protecting the purchasing power of your hard-earned savings, stay tuned. Okay, so I was kidding. We're actually going to talk about 9 different types of inflation. Creeping, walking, and galloping. Those are funny names. You know, economists are interesting people. They came up with those names, I didn't. Then we're going to talk about hyperinflation, stagflation, core, deflation, wage, and asset inflation. Lots of inflations out there to talk about. Creeping inflation is less than 3% per year. Now, the Federal Reserve targets 2% inflation every year, and we're supposed to believe that that's a good thing. But let's look at the result. In this chart, we see what that 2% inflation target has done to the purchasing power of our money since the Federal Reserve was founded in 1913. If we look down here in the corner, we see that minus 96.6%. That's how much value the US dollar has lost. Walking inflation is defined as being 3% to 10% per year. According to the BLS, this is the level of inflation we are currently experiencing. We see that here in this chart, that the current inflation rate, according to the BLS, is 8.3%. Galloping inflation occurs when the inflation rate is over 10% per year. Now, this chart is published by John Williams at shadowstats.com. He's an economist and he tracks inflation using the same methodology that the BLS used back in 1980. Now, if you're unaware, the BLS is continually changing the way they compute or calculate inflation. And their modifications always reduce the inflation that they claim we are experiencing. We can see in this chart in blue, this is the 1980-based BLS methodology for tracking inflation, and we can see that the inflation rate is currently pushing 17%. So if we go by the same methodology that the BLS used back in 1980, inflation is currently running or galloping at 17%. Now, based on my own experience recently of buying gasoline, buying groceries, and paying my utility bill, I believe that John Williams' number, 17%, is more accurate than the 8.3% that the BLS is claiming. Hyperinflation occurs when inflation is running at more than 50% per month. We have several examples of hyperinflation. In the early 1920s in Germany, the Weimar Republic experienced hyperinflation. In 2008, Zimbabwe moved into hyperinflation, and that continues through today. Also in Venezuela in 2016, they started to experience hyperinflation, and that also is continuing through today. This chart shows how gold performed during the Weimar hyperinflation. We can see that in 1918, if we started with a single gold mark, only 5 years later in 1923, that same gold coin was worth 1 trillion paper marks. Now, it may seem exciting to think about being a trillionaire, but in 1923 in Germany, a single loaf of bread cost 200 billion marks. So even though you were a trillionaire, you still couldn't feed your family. Nobody wins in a hyperinflation. The inflation in Germany was so bad that many companies chose to pay their workers in cash and pay them twice a day. The wife would come down and collect the morning payday or paycheck, cash, and immediately go spend that money on goods because they knew if they waited until the afternoon, the goods that they could have purchased in the morning would cost more. That's how bad the inflation was. These children are playing with blocks made out of the German mark rubber banded together. The paper currency was cheaper than wooden blocks or other toys. Here we see a woman burning the paper currency because it was worth less than firewood. Stagflation occurs when we have flat or declining economic growth during a period of elevated inflation. This chart shows the numerous periods of stagflation that occurred during the 1970s. Now let's add gold to this chart and see how the precious metal performed during this decade. It took a little while for gold to respond to the inflation that was occurring. It was 1972 before the price really kicked into gear and started to rise. And then by 1980, early 1981, gold had reached $850 an ounce. So now we have two examples of how gold performs during inflation. During the Weimar inflation, a single gold mark was worth 1 trillion paper marks. In the 1970s, gold started at $35 an ounce, and by 1980, that same ounce of gold was worth $850. This chart shows core inflation versus overall inflation. Core inflation excludes food and energy because their prices vary during the year. Gas prices rise during driving season, the summer, and everything that requires transportation, like food, goes up in price. I wanted to see if this was true, so I created this chart. The gray bars indicate driving season. Based on this chart, I'm not convinced that the BLS premise is accurate. Perhaps a statistical analysis would show a tighter correlation between driving season and elevated inflation. Economists argue about deflation and inflation, so I wanted to start with the definition of deflation, and you can see it here on the slide. Basically, it's an overall reduction in the price of goods and services. Now we have two examples of deflation that we're going to look at. We have a good deflation that occurred from 1870 to 1890, and then a bad deflation that occurred from 1929 to 1939. The Great Deflation occurred as the U.S. industrialized during the Second Industrial Revolution. Economic conditions actually improved during this period as the purchasing power of the U.S. dollar increased. Unemployed workers found jobs as the economy expanded and real incomes grew. Consumers had more disposable income and savings, which actually led to the birth of the middle class. In contrast to the Great Deflation, the Great Depression was caused by the collapse of confidence that occurred after the stock market crash in September of 1929. Consumers stopped consuming and investors stopped investing. Banks collapsed, which caused a significant reduction in the available money supply. Unemployment rose from essentially 0 to 25% in just 2 years. This chart shows how the stock market bubbled up leading into the 1929 crash. If you study financial bubbles, one of the things you will find is that financial bubbles always fully retrace themselves after they pop. And usually there is an overshoot to the downside. And we can see that in this chart of the Dow. Notice how it went lower than its starting point. This chart shows unemployment. On the right-hand side, we can see in 1929, unemployment was essentially 0, and only 2 years later, it had risen to 25%. The next type of inflation we'll talk about is wage inflation. This chart shows the federally mandated minimum wage and how it has risen over time. Now, if we drop down to state levels, we find that often the mandated state minimum wage is far higher than the federal rate. Here in California, our minimum wage is currently $14 an hour. Now, obviously, this rising minimum wage inflates the overall wage rate over time. As consumers, we might think that wage inflation is a good thing. Unfortunately, rising wages feed into cost push inflation, and I'll cover that in my next video. When we talk about asset inflation, we can make a distinction between gentle or benign inflation. It makes sense that the price of assets rise over time as the economy expands and the money supply expands. At times, however, asset inflation becomes extreme, and it's usually focused on a particular asset class. We have several examples of extreme asset inflation. The most commonly known is the tulip bubble that occurred in Holland in the 1600s. And then we have the stock market bubble here in America in the 1920s. And we may be experiencing another financial bubble in the crypto markets. Now let's look at some charts and see what we think. This is the tulip bubble. Notice in this chart how the price of a tulip after the bubble had deflated is actually lower than the price when the bubble started. This is the Dow Industrial Average in the 1920s. Again, notice how the price of stocks was actually lower after the bubble deflated than when it started. Now, we don't know whether crypto is a financial bubble or not. As an investment advisor, I am suggesting to my clients that they treat crypto as a speculation and not an investment. If you are unaware of the difference between an investment and a speculation, I'd suggest that you have some research to do. Basically, with a speculation, you only use money that you can afford to lose. If it all goes to zero, it's not going to affect your lifestyle. That's the key difference between an investment and a speculation, in my opinion. All right, we've talked about 9 different types of inflation today, and we've seen 2 examples of how gold performs during inflation. In my next video, I'll be talking about the causes of inflation. I believe it's important for us to understand why inflation occurs. Folks, if you are concerned about protecting the purchasing power of your hard-earned savings, I highly encourage you to look into the precious metals. We are currently experiencing the worst inflation we've had for 40 years. If you have money in a tax-advantaged retirement account like an IRA, a 401k, a 457, a 403b, a TSP, etc., give some serious thought to a precious metals IRA. That is the only way that you can take your tax-advantaged money and buy silver and gold. In the description below this video, there's a link you can follow to get an inflation protection kit. It will show you exactly how to move your tax-advantaged savings into a precious metals IRA. That's all I've got for you in this video. I hope I've provided some value, and I look forward to seeing you in my video on the causes of inflation.